Okay, everybody together. This is inversion.
That's inversion.
This is steepening.
Yes.
The yield curve. We were
it's kind of like the whole Robin Williams thing with the audience response thing. Yeah.
What's bond market telling us now, though?
You got me. I mean, to me, it seems like they're still worried that the Fed's going to go more times than not. They're worried that inflation is picking up slightly above the Fed's target. And every time you have a sell-off in the stock market, you see a little drop in rates. But it does appear that rates want to go higher. Short end's going higher faster than the long end at the moment, even though the curve's not flattening that much. But it still seems like the bond market's making a bet that the economy is stronger, not weaker. Not true in the rest of the world, but certainly seems to be true
sure.
here.
Jeff, what do you think? Do you think the markets are fearing that the Fed will be too aggressive?
No, I think that the debate is really shifting here, and what you look at the range break on interest rates, and it's really important. We clearly saw it this week in terms of the lack of inflation and inflation story. This is not an inflation story that you're reading out of the bond market. This is the bond market's assessment of the outlook for real growth. And to see that, you got to look at real interest rates, not nominal interest rates. So much of the focus is on nominal interest rates, nominal yield curve flattening. Right. The real story here is in what's happening to real interest rates. And the proximate kind of cause of the range break was when Powell said, we're far away from neutral, probably. And that was really an indication that the narrative, the story, the last 10 years have been all about is low for longer and secular stagnation. And now what we're talking about is something very different, questioning whether or not that's the case. And what the bond market is starting to price in is higher long-term real interest rates. That means higher growth, not recession risk, but the possibility that you're looking at durable higher levels of growth away from this 2% level, more like 3% level.
So guys, I would say this. We've been focused so intently over the course of the past few weeks here on rising Treasury yields. And there are so many other parts of the bond complex out there, specifically with corporate investment grade, also high yield. So maybe if I could just follow up with you, Jeff, about this whole process. Are we seeing this rate picture? Is it going to play out and affect those corporate yields in a negative way? Should we be watching the corporate bond market for more signs of stress? Are there signs of stress, or are things relatively healthy given the picture that we've seen with rising rates on the Treasury side of things?
So there's two aspects to that question. First is that the corporate credit market for today and for the outlook over the next 12 months is very strong. It's a low default rate environment. It's a strong growth rate environment. So spreads are tight, but there's a valuation change that's happening. And it's related to what I was talking about before, which is you got to break down the difference between what are corporate bond prices or spreads doing relative to nominal interest rates versus what are they doing relative to real interest rates. And the big shift that we saw last week was a rise in the real interest rate. What does that mean? It means that the base level of expected returns across the economy is going up because expected growth is going up. Everyone's floor for what you require to return goes up. And in that environment, the cost of capital for corporations has to go up because investors are requiring higher returns. So you saw positive correlation, wider spreads in a higher interest rate environment. That's not risk of default risk. That's actually a positive signal that the bond market is saying, better growth, you got to pay me higher for a better growth environment.
You got a lot of people watching this week who are paying attention to maybe CNBC who don't typically watch, because all of a sudden the stock market is going crazy and all of a sudden they're seeing interest rates
Mortgage rates are at 5% now, right?
Going up. Ron, if you were advising, my grandmother is probably watching right now, my father-in-law, what would you tell them about how to pay attention to what the Fed is doing, the rising interest rates, and the volatility in the market?
Okay, so first I tell them not to, because if you're at that age level and you're still kind of playing around a lot in the stock market, probably from a portfolio perspective and a portfolio management perspective, not the wisest idea. You want to be a little more liquid. You want to be less exposed to risk. So with rising real interest rates, that's not going to be necessarily a major positive for stocks. If you go back and look at the history of some of the biggest market moves that we've seen, negative real interest rates have driven stock prices and valuations higher. So as a family conversation, this gets you start getting in the weeds, and you don't necessarily want to be there with a grandmother, or absolutely not with a father-in-law. You want to make sure that they're appropriately positioned for the cycle of life in which they find themselves. So it's a separate question for people who have much longer time horizon. you stay in. This is not something that you necessarily worry about. We can get a cyclical bear market. We can get a cyclical recession in an ongoing secular recovery in which you stay exposed to stocks if they go down 10, 20% and not worry about it. But with respect to what Jeff's saying, as real rates go up, that puts pressure on stock market valuations, and that's when you do have to lighten the load just a little bit.